This is Nightly Business Report with Sue Herrera and Bill Griffin.
Alexa, how was Amazon's quarter? The e-commerce company trounced earnings estimates, grew its cloud business, and solidified its retail dominance.
About Face, Facebook makes stock market history, but not the kind investors like to see, losing more than $100 billion in value, the biggest one-day loss ever.
Head Start, why savings for retirement is not just for adults, but also for kids, too. Those stories and much more tonight on Nightly Business Report for this Thursday, July the 26th.
Good evening, everyone, and welcome. On this very busy earnings day, we begin tonight with results from the retail juggernaut Amazon. Earnings per share more than doubled what analysts were expecting, resulting in a profit of more than $2 billion. That's a record quarter. So let's get right to the numbers. Amazon earned $5.07 a share. Estimates were for $2.50. While profit was strong, revenue was a bit soft. The company saw revenue of nearly $53 billion, which was up sharply from last year, but not quite as much as expected. And the stock initially popped, but then pulled back in a volatile after-hours session. Courtney Reagan has Amazon's quarterly highlights.
Well, it's not a complete sweep for Amazon's second quarter. While earnings were twice as strong as expected, other metrics fell short. Both North America and international revenues disappointed, but its high-margin cloud computing business, Amazon Web Services, generated more revenue than analysts had forecast. During the quarter, Amazon extended Prime membership benefits to Whole Foods shoppers, but the company neglected to reveal any further details. Amazon's now annual Prime Day shopping event is not part of this quarter, but part of the next quarter to be reported. While Amazon had said it was its best day ever, its revenue forecast for the third quarter that includes Prime Day is well below Wall Street estimates. For Nightly Business Report, I'm Courtney Reagan.
Tuna Amobi joins us now to talk about Amazon's solid quarter. He's senior equity analyst at CFRA Research, joining us tonight. Tuna, always good to see you. Thanks for joining us.
Thank you.
Boy, big beat on the bottom line. Did you see any weakness at all in these numbers tonight?
You know, I think the overall results, frankly, I think had a lot of positive takeaways. And if you've covered Amazon for a while, I think you know that essentially this is a marathon as opposed to a sprint. There's a lot of concerns in terms of the rally that the shares have enjoyed over the last few years. So you can understand why investors are tentative. But I think overall this quarter, obviously they blew away the bottom line numbers. There's some concerns with the revenue targets, but all in all, I think for a company that's still growing revenues 39 to 40% and higher, if you look at the Amazon Web Services, there's a lot to be optimistic about, especially having turned the corner in terms of sustainable profitability guidance as we saw for the Q3 quarter.
So it sounds like you do not share some of the concerns that created the volatility in the stock after hours, even with the big run-up we've seen in the stock.
That's correct. I do have some near-term concerns, especially on the international business, where they had another loss this quarter. I think we know that they're still investing heavily in India. And we also know that the sales of hardware devices, the Echo and Alexa, I think we're really looking for that to drive the secular growth in the smart speaker category. The back-to-school season coming up, I have a sense that this guidance they provided could be quite conservative. If you throw in the Prime Day event last week, Amazon is a company that tends to be somewhat conservative in their outlook. But the one main concern that we still have is valuation, although we have a target price of $2,000, and we're still hopeful that there's still some upside. So
very quickly, would you buy it at these levels here then?
We're still bullish on the shares. That's why we reaffirmed our buy recommendation today with our 12-month target price of $2,000.
Tuna Amobi with CFRA Research. Again, thanks for your thoughts tonight.
Thank you.
And we are watching that race to $1 trillion market cap. At today's close, Apple was still in the lead with a valuation of $954 billion. But Amazon's value may be creeping ever closer to Alphabet's given the stock's move in late-day trading.
Meanwhile, on Wall Street, the market's major averages were mixed. Overall, the Dow climbed, led by shares of Travelers and Disney. The NASDAQ fell, though, pulled lower by that historic drop in Facebook shares. So the industrial average gained another 112 points today to 25,527. The NASDAQ was down 80, and the S&P was down 8 points today.
As we reported last night, Facebook said it expects its revenue growth rate to slow from last year. That warning resulted in Facebook suffering its worst day in history as a public company and the biggest one-day stock value loss in stock market history. So what happens now for Facebook? Julia Borston takes a look.
Facebook raising red flags that after revenue growth slowed more than expected, it will continue to decline meaningfully over the next 2 quarters, while the company's user numbers showed the lowest growth rate ever. And in Europe, user numbers actually declined in the quarter. But some analysts are still optimistic about the social platform's future.
We think Facebook's prospects still look good long-term, short-term. Obviously, there's going to be a lot of question marks around the deceleration. Also
raising concerns, Facebook warned that ads in its Stories features on Facebook and Instagram aren't as profitable as ads in Facebook's newsfeed, though bulls say that could change.
What happens to the revenue per user? Can that keep going up? And with Stories being such a breakout hit for them, which they obviously stole 100% from Snapchat, if they figure out how to make Stories make money, this could be a revenue printing juggernaut for some time to come.
Another factor weighing on Facebook stock, the company warned margins will decline meaningfully in coming years as the company ramps up its investments in safety and security. Facebook is hiring thousands of employees and investing to improve artificial intelligence. The social giant is working on a number of new initiatives to protect user data and prevent other scandals like Cambridge Analytica, as well as to comply with European privacy regulation GDPR, giving up profits in the near term to protect the platform's users because the stakes are high.
If they don't get the security of the platform right, it's all over. And they had a lot of issues about this earlier this year, so they need to get this right. I think that they will. We think that they will. If they can, then this is a good asset. This is the opportunity to buy the stock here.
A key measure of Facebook's success with these investments is how well it protects the security of the platform around the upcoming midterm elections. Consumers and investors alike will be watching closely for any sign of election manipulation. For Nightly Business Report, I'm Julia Borston in Los Angeles.
It probably will not surprise you to learn that Facebook is a popular holding among fund managers. So if you don't actually own the stock outright, you probably still are invested in it in some way. According to FactSet, Facebook is 74% owned by institutional investors, meaning investment advisors, mutual funds, and pension funds. Vanguard, Fidelity, BlackRock, State Street Global Advisors, they are all top holders of this stock. And if you own ETFs, Facebook is 6% of the QQQ, which tracks the NASDAQ 100 index. The technology ETF called the XLK has an 8% weighting in Facebook shares, and Vanguard's communication ETF, the VOX, has about a 13% weighting of Facebook.
So now that the FANG names, which is the acronym for the tech stocks Facebook, Amazon, Netflix, and Google, have reported their earnings, let's take a look at which are worth investing in and which are not. Joining us for our Take It or Leave It segment is John Najarian, founder of the Najarian Family Office. It's always great to have you.
Great to be here, guys.
Especially on a day like today.
Thank you, sir.
Let's start with Facebook.
Sure.
Really a terrible day for investors today. How do you look at the stock and what would you do with it?
I think last night they told us a little too much, Sue. When the CFO, Werner, got on and said basically that margins, which were contracting, as you said, operating margins, down from 60% 2 years ago, nearly 60%, to 44% now, are going to drop into the 30s. And he said that over the next 2 years. That's a lot faster and a lot bigger than anybody thought that Facebook would dip to that kind of operating margin. So that's why people were modeling that into their price targets, and they took them down, you know, anywhere from 20 to 30% today.
So you're leaving it?
Yes, this is one I'd leave. I wouldn't take it. I think there's still more pain to come, unfortunately, Bill. Does it retest that 150 level? Perhaps.
All right. Amazon, you've had less time to analyze because it just came out this evening, but the numbers look pretty good, especially on the bottom line there.
Yep,
huh?
The numbers look great. Amazon Web Services, they were doing maybe 40% better than some of the numbers year over year. They basically dominate virtually every business they go into. They don't kill it, though. People think they're a category killer. I don't really think they're a killer, but certainly they're somebody to be reckoned with. And the fact that they're getting into drugs now, I think is going to be big for them. Obviously, it was bad for Boots Alliance, right. Walgreens, when they announced that, and a number of other drug stocks. But they're not going to take over everything, but they're going to take a bite out of everything. And I think it's just a matter of time before they do the same thing for banks. So this is one that I'd take.
You're taking it then?
Yes, sir.
All right.
You would take Amazon at these levels. You're not worried about the valuation at all?
I always worry about that valuation, Sue, but as long as they can keep putting up these kind of numbers and the third parties that are selling through them, that growth is dramatic. So I still like Amazon, even at $1,800+ a share.
And let's finish up with Google. You like it, basically.
Yeah, I like Google. I mean, they were able to overcome a $5 billion speed bump like that, so I like that. Also, their growth in Asia and Europe is accelerating again, and I think that's a positive for them.
Okay.
Netflix.
So I would take it.
Yes. Are you spelling Fagna?
I might be. Yeah, I skipped over one.
What about
I went
Netflix?
To one when I should have gone to Netflix.
Speaking of net valuations, people worry too much about how much they're spending on content relative to what the stock price is doing right now.
True. And just like Amazon, I worry about valuations. If you're somebody who's investing based on that, then you're going to leave it. I'm a taker, however, because it's already corrected 15%, and they didn't give us the same kind of guidance that Facebook did. So if Netflix would have said, yeah, we're going to drop and it's going to continue to contract, at least for the next 2 years, I wouldn't take it. But since they didn't say that, I think 15% off is a nice sale in Netflix.
All right, very good.
The Fagna.
The Fagna.
Fagna stocks.
Very good.
Thank you, guys.
John, thank you as always. John Najarian. We appreciate it. Bill?
Elsewhere, there were more earnings. Dow component Intel reported strong results, beating both earnings and revenue estimates. But revenue from its closely watched data center business came in weaker than expected, and that's what investors were focusing on. They sent the shares lower in the initial after-hours trading tonight.
It is time to take a look at some of today's upgrades and downgrades. Norfolk Southern was upgraded to hold from sell at Loop Capital Markets. That firm cites the potential for operational improvements either by current management or an activist. The price target is $173. The stock rose a fraction to $169.57. 3D Systems was downgraded to underweight from neutral at Piper Jaffray. The analyst there cites intensifying competition. The price target is 10, and the stock fell nearly 6% to $13.17.
Elf Beauty was downgraded to perform from outperform at Oppenheimer. The analyst there cited challenging trends and increased tariff uncertainty. The firm says that the bull case for the small cap stock has become more uncertain as a result. The stock, though, did rise a fraction today to $14.17. Freeport-McMoRan was upgraded to hold from sell at Deutsche Bank. The analyst cited the stock's valuation right now. That stock's price target now $15.50. Shares closed just above that at $15.97.
Still ahead, airline stocks take off, but will a renewed focus on fuel prices bring some turbulence? Well, here's something we haven't seen in a while, a rally in the airline stocks. Shares of American, Southwest, and Alaska Air all moved higher on better than expected second quarter earnings. Phil LeBeau explains why from American Airlines Operations Center in Fort Worth, Texas.
For all the hand-wringing by investors worried about airlines flying into lower profits, the reality is far different. Alaska Airlines, Southwest, and American Airlines all posted better than expected earnings in the second quarter.
Demand's strong and supply of seats is up a lot. But yeah, no, the consumer seems really quite strong.
The airlines continue to see plenty of demand, thanks in large part to the strong economy. That means there are few empty seats, even as the industry adds more flights. Still, this has been a turbulent year for airline stocks. Why? Well, investors worry the additional flights will make it tough for the industry to raise fares, which would limit revenue growth. But the biggest concern is the rising cost of jet fuel, up more than 40% in the last year. And while that has cut into airline profits, industry leaders are making adjustments in fuel contracts and are prepared to fly with higher prices.
In the end, we don't know. We just try to be as prepared as we can for catastrophic increases, and we've certainly got that kind of protection in place.
The focus on higher fuel prices is nothing new in the airline industry. But for now, the impact of those higher costs are being offset by solid ticket sales and planes that have few empty seats. Phil LeBeau, Nightly Business Report, Fort Worth, Texas.
McDonald's reports slower sales growth here in the U.S., and that's where we begin tonight's market focus. Domestic same-store sales grew at their slowest pace in more than a year, as a matter of fact, missing analysts' expectations. Foreign markets, on the other hand, had a strong performance, and those results helped offset the weakness here in the U.S. Overall, the fast food giants' earnings and revenue came in ahead of Wall Street targets. Shares were off nearly 2%, though, to 156.14 today. After the bell tonight, Starbucks said that an increase in new customers who spent more helped earnings rise above expectations. The coffee chain also said it added nearly 2 million members to its loyalty program. Shares initially fell after hours, but then did rise. They ended the regular session down a fraction at 51.45. Dunkin' Brands earnings rose at a faster than expected clip as higher prices, franchise fees, and royalty income all helped results. The company's incoming CEO said that its earlier decision to cut back on the number of products on its menu has also proved to be the right move for growth.
We introduced the national value platform Go-Tos in the second quarter, and that was a big part of our results in Q2. But we also had some of our highest beverage sales on record in Q2 as well. We think that combination of food with great attachment with the beverages played well. And, you know, for us, again, it's about continuing to modernize and keep our brand relevant for years to come. And the blueprint for growth is all about that.
Dunkin' Brands shares were up a fraction today to 71.19. Comcast said that increased marketing for its internet services paid off as the company signed up more customers, profits rose and topped expectations, but revenue, while higher, did come in a little light. Shares still finished up nearly 4% to $34.75. And remember, Comcast is the parent company of CNBC, which produces this program.
Under Armour said increased investments in its direct-to-consumer and international business caused its loss to widen. But it appears those investments may be paying off. Sales in foreign markets took off this quarter, helping the athletic apparel company beat expectations. The shares rose more than 4.5% to $22.04. Hershey's topped expectations, but rising shipping and ingredient costs pressured its margins. The makers of Reese's Peanut Butter Cups and Kit Kats is responding to those higher costs by hiking prices on a number of its products. The company is also raising its dividend 10%, and it is launching a $500 million share buyback. Hershey shares climbed more than 7% to $99.66. And after the bell, Amgen said strong sales of its new drugs helped earnings beat estimates. The company is also raising its full-year guidance. Separately, Reuters reported that Amgen is facing roadblocks from insurers as it tries to get its new $575 a month migraine treatment on the market before the competition ramps up. Shares were initially higher in the extended session. They ended the regular day up a fraction to $194.05.
Treasury Secretary Steve Mnuchin said today that the trade deal being discussed between the U.S. and the European Union will come in stages. During a CNBC interview, he said that yesterday's talks with the European Commission president is the starting point for resolving a lot of trade issues with the goal of eventually eliminating all tariffs.
The first issue that we'll immediately begin negotiating is to resolve the issues on the steel and aluminum tariffs and the retaliatory tariffs. So Phase one will be to immediately resolve those issues so that there'll be no tariffs in either direction. President Trump has said that as long as we're negotiating the overall agreement, that there will be no new tariffs in either direction.
Secretary Mnuchin was tight-lipped about trade relations with China, but he did say that the Treasury is closely monitoring the recent weakening of the Chinese currency.
On Capitol Hill, the U.S. trade representative told lawmakers that he is hopeful a new NAFTA deal can be reached soon.
Hopefully, we are in the finishing stages of achieving an agreement in principle that will benefit America's workers, farmers, ranchers, and businesses.
Separately, Mexico's economy minister, who was scheduled to meet with the U.S. trade representative today, said his goal is to speed up talks with both the U.S. and Canada.
On the economy, orders for durable goods rose for the first time in 3 months, driven by a pickup in business investment. That's the good news. The bad news is the rise was well below expectations, in part because of a sharp decline in defense orders, which posted its biggest decline since March.
Tomorrow, the Commerce Department will release its first official estimate of second quarter gross domestic product, which is a broad measure of goods and services produced across the country. And as Steve Leisman reports, expectations are high.
It's the one economic number that everyone is talking about. Second quarter growth, which could be as strong as 4 or even 5%.
I think most people understand what President Trump is doing, and what we're doing is good for the economy. I think, as you know, we're looking forward to a very strong GDP number. We have real economic growth.
Earlier this week, the president tweeted out, in perhaps a veiled reference to the coming GDP report tomorrow morning, quote, "We have the best financial numbers on the planet," end quote. That's a bit of hyperbole, but the median of 12 economists surveyed by CNBC do see gross domestic product for the second quarter coming in at 4.1%, which would be the strongest quarterly number since 2014. For the administration, the number is nothing less than proof that its tax cuts and deregulatory economic policies are working. But economists say there are also some temporary factors in the numbers, including a surge in government spending.
The quarterly numbers are pretty volatile, and we've really juiced the economy with fiscal policy. So the underlying trend has already been moderate. Build in some fiscal oomph on top of that, and you've got some real momentum here.
There could also be some additional trade and inventory building in the number as businesses bought and stocked goods ahead of coming tariffs. But that won't explain all the strength. Consumer spending and business investment should both also be strong, likely driven by tax cuts.
It is not all due to exports. There seems to be some, pretty solid underlying growth here that can't be explained by, one-off factors like exports or inventories or something like that. Some of this is the tax cut. Some of this is the increase in discretionary spending. And some of this is an underlying economy that's quite healthy at this point.
Only the actual data over time will tell how much investors and the public should begin to believe whether the high growth is permanent or just a temporary talking point. For Nightly Business Report, I'm Steve Leisman.
Coming up, kids and money, why it's never too early to start saving for retirement.
Here's a look at what to watch for tomorrow. The oil giants and Dow components, ExxonMobil and Chevron, are out with their earnings. We'll also hear from the blue chip company Merck. 21st Century Fox and Disney hold a special shareholders meeting to vote on the merger between Disney and the Fox assets. And as we just mentioned, we'll get the first read on second quarter economic growth. That's what's to watch for on Friday.
That's good. We should do that more often. Some kids are getting a head start on saving for retirement by contributing to an account designed just for them. Fidelity says that the growth of its Roth IRA for Kids program is up a whopping 475% since the product was announced back in 2016. Maura Cassidy is Vice President of Retirement at Fidelity. She joins us tonight to talk about that. Maura, thanks for joining us tonight.
Thank you for having me.
So I'm the adult opening the account. I have to be over 21. I'm opening it for a person under the age of 18, and they have to provide their own earned income. Why a Roth IRA? I'm curious.
Well, one of the great benefits of a Roth is that you can withdraw the contributions at any time, tax-free, since they went in after tax. So for a lot of people, putting money away in a Roth seems, at age 15, it seems like retirement's so far away. So they can use it for, qualified educational expenses or their first-time home purchase in the, in later years. But it's a great way to get that habit going of saving for retirement and putting some of your earned income away.
You say it's really a teaching moment and that the parent can contribute, certainly, but it's the time that you should take your child and teach them about compounding and really a life lesson in money.
Right, exactly. It's a great opportunity, say, talk about how much did you earn this week, how much should you put away for savings, and how that can grow. That's exactly right.
You know, it occurred to me when I heard about this, you started this 2 years ago. What took so long? I know you did it because of the demand you were getting from some of your customers, but, you know, IRAs have been around for a long time.
Right. It is something that our customers had been asking for. We hadn't had an account for retirement for people under age 18. And so we had to get over a couple of hurdles, but once we launched over those hurdles, we just saw the pent-up growth that we've experienced over these 2 years, and it's been great.
Yeah, what kind of increases have you seen?
Well, like you said, triple digits, over 400%. It's amazing. This year alone, we've seen, you know, over 30% in new accounts opened just in this year, January through June. So, you know, that's great growth. And we're going into the time of year in the summer where maybe a lot of kids have a summer job,
right,
and we expect a little bump from that.
So that's a lot of lemonade stands that they'll be opening there.
Right.
Maura Cassidy with
or
Fidelity.
Lawn mowing.
Yes.
Yeah.
Thanks for joining us tonight. Appreciate it.
Thank you for having me.
Before we go, let's take a final look at the day on Wall Street. The Dow rose 112 points to 25,527. The Nasdaq dropped 80, dragged down by that historic drop in Facebook. And also the S&P, it was down about 8. Facebook shares, as we mentioned, had their worst day ever after reporting that disappointing quarter and guidance. That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
I'm Bill Griffith. Have a great evening. We'll see you tomorrow.